Well, against the backdrop we've been unpacking here at the desk so far, we've had market participants saying that they're steering clear of the euro heading an 11-month low, the dollar index an 11-month high. What's your stance?
Oh, well, yesterday we did see the rand trading largely within our trading range for the day, which I mentioned yesterday. But towards the end of the day, when we saw the Federal Reserve announce that they weren't going to introduce any QE3 and the fact that they were going to keep interest rates unchanged, we really saw a race in the currencies, and we saw the dollar strengthen quite considerably, and obviously that had an impact on the Eurozone and the euro. And as well as the rand, sorry. So we do expect further weakness in the currency on the back of the fact that investors seem to be staying very clear of the Eurozone due to the fact that the debt crisis is really not reaching any kind of solution in that region. So we do expect further weakness going forward over the next couple of days and into 2012 on the back of the fact that conditions in the Eurozone don't seem to look any more favorable than what they have, or rather than what the United States is looking at the moment.
What kind of trading range do you have pegged out for this period on the local unit versus the dollar? Because we're sitting at about that 831 mark. We saw the unit move all the way to 837 in yesterday's session.
Oh, well, we do believe it's going to be a fairly light trading day today. So we do expect to see a move towards 828. But if we do see a breach of 833 to the upside, we could possibly see a move towards 846 during the course of the day and into tomorrow.
Of course, things seem a little calmer this morning, but looking at things, I mean, a break off that 130 mark on the euro dollar is where we're at right now, would send all risky assets spiraling. So that's the risk at this stage of the game. And with that, we've got a key Italian bond auction that's in focus for investors. We've had other European debt issues this week having gone surprisingly well. What's your outlook on the Italian bond front?
Well, even though that has gone surprisingly well, the Italian bond fund is expecting to sell about 3 billion euros worth of its debt, and the German bond market as well, about 5 billion worth of its debt. And if those auctions don't go according to plan, or if it's a lot softer than what we have seen, as we saw with the Spanish bond auction as well, we could see that really putting pressure on the euro, and it's really going to be a selling catalyst for the euro. So the picture doesn't look very pretty for the euro at this stage.
With all of that playing out globally, Shireen, I mean, just how much attention are you paying to the local data flow that we're anticipating? Of course, we're anticipating CPI numbers, and that expected to breach the 3 to 6% target band.
Well, CPI is always prime focus for us, and we're expecting inflation to increase to about 6.2% in November from 6.0% in October, and it's slightly below market expectations of 6.3%. We do expect the main culprits, mainly the food and fuel prices, to continue driving that inflation number quite high, but we don't expect any other kind of forecast risk on the back of the fact that there were no additional surveys coming through for November. But we do expect the inflation trend to continue higher over the next 6 to 12 months. We did see yesterday's BER inflation expectation survey also indicating that CPI is likely to remain close to the 6% target level for the next 2 years. So we're more or less in line with those expectations. We don't expect the Reserve Bank to really alter its view at this point. Yes, indeed, inflation is spiraling quite high, but they're also cognizant of the fact that GDP growth is still quite low and that it came in below expectations. So they have to really find a fine balance between the lower growth and the inflation numbers. At this point, we do expect the Reserve Bank to keep interest rates unchanged through 2012.